War always brings down the economy. The Western world's condemnation of Vladimir Putin's activities has resulted in the imposition of major economic penalties against the Russian state, among other things. Although it is still too early to predict how the dispute will play out in its entirety, the initial economic ramifications are already being felt. What can we anticipate in the next months in nations affected by the Russia-Ukraine crisis, whether directly or indirectly? Well, in this video, we are going to discuss the million-dollar question: what impact will the Ukraine conflict and Russian sanctions have on the global economy? Hello viewers, welcome to the Ukraine war. We are here to deliver you updates on all the new political moves regarding the Russia-Ukraine conflicts, the casualties, strategies, and aftermaths of the ongoing war in detail. Subscribe to our channel and hit the bell icon if you don't want to miss any of those. Having said that, let's jump into today's topic. The globe is experiencing a significant stagflation shock, albeit it is not as severe as the one that happened between 1973 and 1974. But before we look at the global situation, let's have a look at Russia. Russia is destroying the modern, outward-looking sector of its economy by isolating itself from the rest of the world. It is entering a spiral of inflation and depression, having been cut off from the international financial system and subjected to a partial embargo on American and European imports, ranging from technology to aircraft parts, with the ruble losing 32% of its value since the beginning of the year and 72% since the annexation of Crimea. Despite the crimes committed in Ukraine, the dictatorship continues to profit from oil and gas sales to Europe. In this context, I'd want to attract your attention to a demand by a group of economists to cease funding Putin's war by enacting 3 measures to help cushion the shock: an oil embargo, a tax on gas imports, and tax transfers to low-income earners. Russia's future does not appear to be completely bleak. If a suitable solution is achieved fast, the sanctions that are presently wreaking havoc on Russia's economy may be withdrawn. The shock would be temporary in this case, and the economy would recover. The Russian economy, on the other hand, would irreversibly shrink if Ukraine was occupied for an extended period. The IMF predicts that Russia's GDP would decrease by 7% in 2022 as a result of the sanctions already in place. Given the severity of the sanctions, this figure appears modest, but it follows a period of rapid development in early 2022. If we evaluate GDP between the end of 2021 and the end of 2022 instead of an annual average, the loss will almost certainly be even sharper. But it isn't the most crucial consideration. Putin's plan is dooming Russia to a long-term slump, with a permanent loss of 15% to 20% of output and a corresponding drop in real wages. Putin's ambition of a pivot to Asia is a mirage. Cut off from the West, Russia would become a vassal state of Chinese power. Let's return to the topic of the global economy. On numerous fronts, it is experiencing a large-scale supply shock. Supplies of fossil fuels, wheat, potash, nitrogen fertilizers, and industrial metals like nickel and titanium, which together account for the majority of Russia's and Ukraine's exports, have been drastically cut. As a result, world prices for all of these commodities have risen, as we have seen in the case of nickel, which has been particularly volatile. Stagflation was already being discussed before the invasion of Ukraine due to rising raw material prices and bottlenecks in global supply chains. But that apprehension was only temporary, and it was meant to dissipate as supply networks restored to some semblance of routine. Everything has altered now. Not only will the shock be considerably bigger and affect a wider range of channels, but it will also most likely continue longer. Supply constraints would certainly dampen activity in areas that have previously experienced shortages or supply delays, such as the automobile and electronic component industries. At the same time, growing inflation will erode consumers' purchasing power. This massive shear will lower economic activity while increasing inflation, resulting in job losses and reduced corporate earnings, as well as reduced investment and eventually ballooning government deficits. As I have stated regarding Russia, the stagflationary shock's implications are highly dependent on the length of the conflict. Even in the best-case economic scenario of a quick peace accord, the anticipated return to pre-invasion conditions would be sluggish. Further increases in inflation would be dealt with by central banks, but the ultimate difficulty would be determining how to reduce inflation without delaying the recovery. Due to costly and time-consuming supply chain modifications, the world economy would find it more difficult to return to a balanced development path in the more likely situation of a stalemate and longer protracted sanctions. This will have an impact on all countries, albeit to varying degrees. France and the United Kingdom, for example, trade with Russia less than Germany and Italy, and as a result, the latter two will be hurt the worst. Do you agree with the Minister of Finance's description of a shock comparable to that of 1973? Well, you've too. The 1973-1974 oil shock was a massive negative supply shock for the global economy. Due to the oil monarchs' low proclivity to consume their new and enormous earnings, the new petrodollar flows from oil importers to OPEC were not a zero-sum game. But there are three significant changes between today and 1973, in experts' opinion. Number 1. The shock's initial size is smaller. The price of crude oil increased by 370% between 1973 and 1974. If oil prices stabilize at roughly $110 per barrel as of March 28th, Brent crude was selling at $113 per barrel. The rise between 2021 and 2022 will be 180%, a tremendous surge, but only 60% of what it was in 73-74. Number 2. Developed economies are less reliant on oil and are less energy-intensive in general than they were in 1973. France's example is particularly instructive. In 2019, fossil fuel use was 71% lower than in 1973. Other things being equal, the French economy is now 3.5 times less vulnerable to fossil fuel price fluctuations, even though the cost of energy has increased dramatically, which was not the case when prices were regulated. A cautious assessment predicts a shock 3 times less than the one experienced in 1973-74. Number 3. The global economy was significantly less intertwined in 1973 than it is now. While the oil shocks of the 1970s ushered in a new era of globalization by allowing OPEC oil-producing nations to trade with the rest of the globe, the Soviet Union, China, and India stayed outside. China now dominates global commerce, both in terms of exports, 12.2% of global exports, and imports 11.2%. Assuming that China is less harmed than OECD nations, a shock-absorbing framework that did not exist in 1973 would assist the global economy. A COVID-linked factory closure in China, on the other hand, would exacerbate the situation. As may be seen, analogies to 1973 are limited. In its most current note to conjecture, INSEE presents a balanced perspective on the French economy. We must highlight the outstanding work of the professionals at INSEE, who have effectively pulled as much data as possible from different company surveys to correctly appraise the situation. They present 2 especially crucial observations by correctly underlining the considerable uncertainty posed by the conflict and the length of sanctions. Following February 25, French business leaders swiftly revised their forecasts lower, notably in the retail and manufacturing sectors. It's worth noting that a similar study conducted by the New York Fed had similar results. Services and construction, on the other hand, were mostly unaffected at this point. The retail industry's pessimism is explained by rising costs and their influence on consumption, but for manufacturers, the danger of shortages of crucial materials is more likely to be a source of concern. In addition, INSEE used macroeconomic models to evaluate the short-term impact of recent energy price rises without assuming any economic policy reaction. The outcome was a 0.7% drop in French GDP in 2022, compared to what it would have been if the shock hadn't occurred. The OECD estimates 1.4% of the Eurozone as a whole. The discrepancy is due to more conservative assumptions and the fact that France is less vulnerable than the Eurozone average. Assume that the impact on France in 2022 will be roughly 1% of GDP, and that in the event of a lengthy conflict, growth will be cut in half in 2023. Growth would decrease to 2.4% in 2022 and 1.5% in 2023, according to the Banque de France's baseline assumption of 3.4% in 2022 and 2% in 2023. This is a substantial shock, but not on the order of the 6 percentage point drop that occurred after October 1973. Furthermore, even if employment growth slows, the economic slowdown would not be sufficient to dramatically raise unemployment. What economic initiatives could be anticipated to lessen the shock? Before the invasion of Ukraine, economic policy decisions were limited by a set of criteria that might be described as do enough but not too much. The goal was to minimize the public deficits caused by the epidemic as quickly as possible without jeopardizing the recovery. France took this step, although with prudence as is customary for the country. The inflation check, or the decision to control rises in gas and electricity prices, an odd manner of reacting to an energy supply shock, given it does all it can to keep the demand from falling, had already had a significant impact on the route to reducing the budget deficit. The decision to grant a 15-cent per liter discount on diesel and gasoline bills for 4 months would put a further burden on the budget. Although this step can be attacked on the same grounds as the energy caps, it has the benefit of being a temporary tax cut rather than a difficult-to-reverse tax cut. The previously planned decrease in the budget deficit from 8.4% of GDP in 2021 to 4.84% in 2022 will be drastically reduced, with a deficit of 6% of GDP becoming more plausible. We may be experiencing a paradigm change. The whatever-it-takes strategy used during the COVID crisis, which allowed for survival by limiting economic damage, might be continued by taking a war economy position and employing the whatever-it-takes policy, but for different reasons. We are living in unprecedented times. The escalating horrors of war on the European Union's borders, the transformation of an authoritarian regime, which expresses its Euro hostility through backdoor methods such as supporting Europhobic political parties, into a dictatorial regime with the world's largest number of nuclear warheads, and the threat of the harshest retaliation against those who dare to challenge Putin. All of these issues will have a significant impact on global economic policy. The clearest example is Germany's decision to quadruple its military expenditure. The U.S. Federal Reserve has managed to halt the decrease in real interest rates. This is what the concept of the war economy entails. Raising taxes in the face of stagflation would be counterproductive. The only choice now is to take on more debt. The ECB will most likely be considerably more cautious in this situation. If the shock lasts for a long time, it may likely go so far as to initiate a new government debt buy program, in which case it will push aside the aim of 2% inflation for better days ahead. Now, as you can perceive, we are thoroughly approaching an era of immense economical crisis worldwide. The stock market and cryptocurrency too are facing a nosedive. So what's your take on the current scenario? Tell us in the comments. If you like this video, please give it a thumbs up, subscribe to our channel, and turn on notifications so you don't miss any of our upcoming videos. Until then, peace.